Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. In recent news, Congresswoman Marjorie Taylor Greene has introduced the No Tax on Home Sales Act, and it has received supports from the Trump administration when he stated that they are taking a look at it. So today we want to talk about what it is, what it isn't, maybe some examples, and if we get to it at the end, if this will accomplish its objective of spurring the housing market. So what is this No Tax on Home Sales Act?
Currently, you're allowed to exclude gains from the sale of your home. For example, as an individual, you can exclude up to $250,000 of gains. If you're married filing joint, you can exclude up to $500,000 of gains from selling your primary residence, your home. With this provision, it would remove all of that, and you can sell an unlimited amount of gains and not pay any taxes.
Okay. Yeah. So we're still a long ways before this actually becomes a law. This is still in the House. It hasn't even made it to committees yet.
But spurring headlines quickly.
Right.
Lots to talk about.
Yes. And there's a little bit of confusion. So I think we want to just clarify some of that. So this is for principal residence. This isn't for exchange of real property for productive use or investment.
Right.
Okay.
Right.
I've even heard some people comment to an old provision back from 1997 that has been repealed by this current one, which is rollover of gain from principal residence. This is not that.
Not that.
Okay. So you mentioned the requirements of Section 121 and the fact that it has to be principal residence. I think some people, I've received the question, okay, what about my vacation home or my second home? Does this apply to that?
So it doesn't. It is purely so. This only applies to a single property, and so there's actually some rules and there's some things that they utilize to determine what that single primary resident property is. So if you do have a vacation home, the way that they test that is they determine where you're spending majority of your time and where you're living majority of your time. They also look at other factors as far as what address is listed on your tax return, what address may be listed on your driver's license, as well as additional ancillary things like where's your office or work location as far as in proximity to one of your properties. If you're part of some type of church community as well, where is that located in regards to where that property is? So they're going to go based off of where you spend most of your time in determining which one of those properties, if you do have multiple ones and consider multiple homes, which one of those properties falls in lines with a lot of those guidelines.
Yeah, I believe they use ownership and use, right? So, right, can you show ownership of the property, that you've lived there for 2 out of the last 5 years, and that you have the actual use of it, that you're actually living there? And so they have some little rules in regards to a 5-year period is kind of what they look at a lot.
Yeah, so let's talk about some of that, like how those requirements apply in real life scenarios. So I'm going to borrow my own example. So I got married in 2013. I had been living in my principal residence for 2 out of the previous 5 years, so 2008, 2013. I met the requirements of Section 121. I moved in with my wife into her house that she also met the ownership and use requirements in 2013. And then in 2017, we sold that house to move into another house. How much, if any, of the exclusion did we qualify for in that scenario?
You qualified for the full joint exclusion of $500,000 because for spouses, only one spouse has to satisfy the owner eligibility, but both of you have to satisfy the use eligibility. So both of you had to live there for 2 out of the last 5 years. So congratulations. You married up, sir.
Nice of you to move into her place as well.
You hear that?
See, honey?
Okay. So when I sold my house in 2013, when I got married, do I get the exclusion on that?
You owned it for at least, yes, yeah, absolutely.
So I can get the exclusion in 2013 and 2017.
Yes.
Well, that's a pretty good deal.
Yeah.
So I think it's important to understand that you can only get the exclusion every 2 years. right? So if you happen to use that exclusion on your, let's say you had sold your original property first, right? You sold that property, you would have had to wait 2 years before you sold the property that you moved in with your spouse in order to receive the next exclusion.
So in other words, if we had moved out of her house in 2014, I couldn't have used it on both. If I sold the house in my house in 2013.
Correct.
Yeah. Okay.
Yeah, that's probably one of the rare situations where you probably would see someone sell a house and then sell another house within that 2-year time frame. But understanding like, hey, you already used it, can't use it again within that little time frame.
So how does it change? So same circumstances, except I don't sell the house in 2013. Instead, I turn it into a rental property. But I sell it in 2015. How does that work? Do I still get the full exclusion?
So so the exclusion still does apply, but only you would be able to get the exclusion. So you wouldn't get the full spousal exclusion of $500,000. You would get the just the $250,000 exclusion for yourself as an individual in that circumstance.
Does the fact that I rent it change anything in that?
So the rental aspect can change. The reason why it does qualify is because you're still within that 5-year time frame, and you still fulfill the use test. But the rental aspect does change things over time, and especially if it goes past the use test, then there's no qualification whatsoever. But you're no longer utilizing as your primary residence, right? Someone else is utilizing as their primary residence. But in that circumstance, since you did have that as from a use perspective, you still have a qualification.
I would have used it as my principal residence in 2 out of the previous 5 years.
Correct.
So I could still qualify.
Correct.
Yeah.
You could, but if this, let's say you're using the home, and at the same time you're renting like a room, you could still qualify for the exclusion. But if you took some depreciation for that portion that you're renting out, you have to exclude that from the gains. So,
Okay. Yeah.
so for example, if you sell this house and you have a $50,000 gain and you took $10,000 of depreciation, you have to recapture that depreciation, and so now you can only exclude $40,000 of gain, and that may or may not be taxable. It will be under the exclusion in this case. Yeah.
The 40,000?
Yeah, of 250,000. Yep.
So when you say recapture of 10,000, so is that tax free?
No, unfortunately not. It's taxed as ordinary income.
Okay.
So it sounds like they've thought of almost everything.
Yeah.
No loopholes.
Okay. Well, you know what? That brings up a situation, right? That we see a lot down here in our area, and I'm sure there's other regions in the country that also experience this. Mm-hmm. But I know a lot of people that will buy a fourplex, live in one as their principal residence, and rent out the other 3. So how does the exclusion apply or doesn't apply in that situation?
So the way that they'll define it is they'll split the fourplex into 4 separate units. So if you're utilizing just one of those units as your primary residence, as your personal primary residence, and you meet all the qualifications for 121, that individual unit is the only thing that applies for you. So in this for example, if you look at a fourplex and let's say you purchase the fourplex for $500,000, right? One individual unit of that fourplex would have a cost basis of $125,000. And let's say in 3 years you sell that fourplex for $1 million. Well, you are only allowed to get to qualify for 121 on a quarter of that $1 million, which is $250,000. So that $125,000 gain for that one unit would qualify under 121. The other units would not. And so the gain on the other 3 units that you received in this circumstance, it'd be, $375,000, right? That $375,000 would be considered long-term capital gains for those other 3 units.
Y'all mentioned cost basis and remodeling. So what are some specific remodeling costs that can be added to cost basis and or any other expenses that can be used for cost basis purposes?
Yeah, so you want to take into consideration really anything that improves the house. And when you think about that, there's things that are maintenance costs, right? And Credo had mentioned it over time, right? Lawn maintenance, pest control, AC servicing. Those are all expenses that are utilized to maintain the property. Aside from that, you have things that help improve the property. So if you think about it, adding a new roof, adding a pool, putting in a brand new AC system, remodeling your kitchen, bathrooms, doing floors, any of those things that upgrade the property and provide new additional value. So if you looked at it from an actual real estate market perspective, anything that actually provide monetary value in the eye of a buyer, that is something that you would be able to include. And then on top of that, you also want to look back at closing documents from your original purchase, because based on those closing documents, you can look at your closing costs from the original purchase. That can be added to your cost basis. And then any commissions paid to your real estate agent as well too. Whatever that number is, that could be included on your cost basis as well. So many different things can help elevate your cost basis, not just what the initial purchase price was when you first purchased the home, but all those things over the years. And especially if you've owned the home for 20 years, there's so many different things that you could have added to it to improve it over that time frame. Making sure that you're keeping track and keeping good documentation and record of those improvements will help a lot.
Yeah, just like a simple example. Let's say you purchased the house for $200,000 and you've been there for quite a bit, and you're married, filing joint, and now it's worth $750,000. And you qualify for the $500,000 exclusion, and in this case, you'll have $50,000 that would be subject to gains. So you would add these things to your cost basis of $200,000, the pool, the improvements, and let's say with the addition of those improvements, your cost basis is now $250,000. And in this situation, you would qualify for the full exclusion and not owe any capital gains taxes.
That is a really cheap pool. Really cheap. I want to know where that pool company is located.
Come on over.
So if I'm adding those things for tax purposes, you mentioned investment purposes, like considering all the ancillary costs of maintaining a property. So you as a financial advisor, now we're not giving a recommendation to anybody, but how do you view that thought of, I'm going to sink all my money into a big property instead of investing my money in liquid assets? How do you view that?
To me, I view it as, is this your home for your family? Is this for personal use? And if it's going to be for investment use, you're going to have to do a rate of return calculation versus the stock market, the net return versus real estate, and you're going to have to decide what are you using as your basis. And for me, right away, I focus on the big things: property taxes and insurance. I add that in my calculation as the basis for the investment and compare the two. But also liquidity. Stock market is liquid, real estate is not. The reason why it goes up and down every day and the values are reflected, because at any time you can sell it. It's a good and a bad thing. Real estate, you don't see it every day, so that's could be a good thing, you don't.
But it's happening.
So
I'm not sure that we made this abundantly clear. Do you have to put the cash into another property to get this exclusion?
Oh, yeah, you do not. You do not. So that's why we had mentioned this has nothing to do with 1035 or anything like that. This is purely 121 coding. So you do not have to move that capital gain into another property. It is purely just, the sell of the game. So if you wanted to sell it and then,
Take a trip, go buy groceries,
go to Europe, take an RV around the world,
bury it in the backyard.
Yeah, whatever the case may be.
As long as you don't have to pay taxes.
Next to Barry, right next to Fluffy in the backyard, whatever the case may be. Yep. So if that's the case, you do have, that's, you still qualify. There.
Yeah. So, okay. We're living through an era where there's this gig economy, right? I think the Small Business Administration puts the number of micro businesses in the country at 45,000. So presumably a lot of them are working from home. they're taking home office deduction. So how does that interrelate with Section 121?
I think it goes in the same lines that Karita was talking about. If there is some sort of depreciation or some sort of income that's being generated off of that room or whatever it may be, you're going to have to recapture some of that income, right? And so therefore you won't be able to exclude the full amount. There'll be some sort of reduction.
Okay, cool. All right. We live in South Texas, so there's a lot of people with a lot of land, vacant land. So they might have a house, I don't know, 3,000 square foot home on 20 acres. Does the entire 20 acres get excluded from gain?
It could if it's adjacent to your property and you're using that lot as part of your primary residence.
I think the big thing there is what is the use of it, right? So going back to some of the use and ownership aspects of it, what is the use of that extra property, right? I think common things around here, people like to put horse stables, things of that nature. They're using them for their own personal use, then it could be excluded. But the moment that they start generating some sort of income, it goes back to those same rules of having to recapture.
Yeah, you see it a lot. Like the ranch properties, people will utilize part of it for dove hunts or for some type of hunting, some type of hunting experience, and then produce revenue and some type of income for that part of their property. And normally they'll probably have that portion of the property kind of marked off to some degree, but it is adjacent to their home properties. So they have to understand that, hey, if you're producing some type of revenue or utilizing it for business purposes, even though that land may be adjacent to your home, it's not going to qualify.
What happens if I sell them at different times? So in that scenario, let's say, you know what, I just want to downsize. I don't want to maintain these 20 acres. So I'm only going to keep the acre that my home sits on. So I'm going to sell that other piece.
So I think it's important timing, right? So kind of going back to that 5-year window, right? They're looking a lot of times at if you did it within the last 2 years of that component, you still may be eligible for the 121. If you go past the 2 years, then you might lose some of that eligibility.
Okay, got it.
I think it's really important, just kind of going with that same line, that 2 years, I think that's very important because sometimes different circumstances occur, maybe a death from a spouse, and they might be grieving and might make a decision to downsize at some later point in time. If they do it within the 2 years, they still may be able to utilize that 121 for the spouse and be able to get up to $500,000 in gain. I think it's also important to understand that the same thing could happen in a divorce, right? So in a divorce case happens, you kind of have to go by the decrees and see exactly how it's laid out. But there could also be ways for both parties to receive 250, not necessarily one joint, right, of the 500. So you got to look at the rules.
Okay.
Yeah, the joint filing is really important in that circumstance, right? If your spouse is deceased, but you're still filing jointly for that year, and you end up selling the property, then you do get the spousal benefit there, as far as just filing jointly and getting the full benefit for 121.
This is probably not as common a scenario, but I think it's worth pointing out. The Internal Revenue Code section specifically says dwelling unit.
Dwelling.
So what is a dwelling unit? Like what types of different properties can qualify for 121?
Man, there's a bunch. There's a lot. Yeah. So obviously single family homes, townhouses, we talked about fourplexes. You can look at different other different properties as well too. You look at trailer homes, you can look at
Boat homes.
Yeah, boats. RVs. There's all different types of vehicles that qualify based on your living arrangement, right? And so making sure that you meet the use test, and as far as that being your living arrangement, and has all the requirements in that either building, because the boat idea. The boat idea.
Trying to convince Felicia to for a retirement house to be a boathouse.
Boathouse.
Yeah.
I literally, that's the first thing I thought was, how are you gonna swindle this one over the years and to get onto the boat property?
She already told me no, but I thought about just going from port to port.
He's already grown. He's at least waiting till retirement. He's matured.
He's planned how he's going to propose this in the next 25 years. please.
You got to start now.
Yes.
Maybe if we can get this bill passed, maybe that'll help.
Yep,
but
that'll help.
Yeah.
My daddy used to say that's called planting the seed.
That is small sprinkles of water over time.
Okay, so let's spend some time now that we got the. What is there anything else? Any other examples that y'all can think of that you want to share with the audience?
You can still get a partial exclusion, even if you don't. You're not eligible for the use tests. For example, if you get a new job and it's 50 miles farther than your last job. For example, if your last job was 15 miles away from your home and your new job is 65 miles away, that can qualify for a partial exclusion. So, for example, if you've owned a home but you've only lived there for 12 months, you can get a partial exclusion. What you would do is divide the amount of time you were there divided by 24 or 2 years. So in this case, if you only lived there for 12 months, divided by 24, that's 50% of the exclusion. And so you can get potentially $125,000 still of an exclusion.
We have a pretty big military presence in our area as well, and I think that they also apply. They have some different rules just due to circumstances of them having to be on leave. So they have some extra extensions as well too. So I think if they fall into those circumstances, they need to review that and see if they qualify. I think that's really important that they understand they're not always excluded just because of that.
All right, so I think we should spend some time talking about the objectives of this bill. There's a lot of different objectives. One thing that people say is that these limits were established in 1997. You've seen home values increase. There's been no inflation adjustment like other provisions in the Internal Revenue Code. But I think primarily they're trying to use this to raise home inventory, to make housing more affordable. But is there really going to be that many people that are going to be impacted by no limit on the exclusion amount? In other words, are there that many people that have over $500,000, married filing jointly people that have $500,000 in capital gains in this country?
National Realtor Association had did some testing, and they determined roughly about 10% of the population in the United States would actually qualify for capital gains that are above those limits. But there's regions that those numbers are a lot higher, right? So California, they looked at average home sales, and roughly about 26% of their average home sales were above those limits. Other states that you would look at would be state of Washington, Massachusetts, Washington, D.C. area that have higher than average home sales that are above those limits. But if you look at it from a national average, it's about 10%. So it's still a really small number relative to the entire country on average.
I'd also like to input that most of those homes are over $1 million, right? So they are higher valued homes. So how that will affect the general public is interesting to see.
And I think it's one piece of the equation too. Post 2008, we just haven't built enough homes in the U.S. Banking rules have become stricter. So you needed higher credit score. You needed to have more in savings. And so as millennials reach their home buying years, there was not enough homes to begin with. And so that's just one piece of the equation. So you got to look at all the pieces.
I think that same study, it was 10% that surpassed the $500,000, but I think it was about 34% that passed the 250,000. Yeah. So if you are one of those people that does have gain in excess of those amounts, how does the taxation work on there?
Yeah, so I think it's important to understand that they still qualify up to their exclusion, right? Single, 250, married filing joint, 500. If they go over those limits, right? So we'll use the 250, for example. If they happen to have a $300,000 gain, the 250 will be excluded. That $50,000 will be taxed as a long-term capital gain.
Good.
Yeah. Understanding, meeting the requirements, right? So in that circumstance, because they've had the property over a year, you have that long-term capital gain benefit, but you wouldn't get the exclusion if you didn't have it for over a year anyways.
The house that I'm going to buy is going to appreciate that quickly.
Yeah.
Yeah.
Real quick.
Speaking of that, I want to get y'all's thoughts on some comments I've heard that how the passage of this could impact the capital allocation decisions. In other words, higher valued homes tend to appreciate more than lower valued homes. And some people are concerned that this might drive people to buy higher valued homes at the expense of less investments into stocks and bonds. Since you could potentially get tax-free money.
Yeah.
So what are y'all's thoughts around that?
I've seen a lot of people do things like that, right? Contractors where they build a house, live in there for so many years, and then they go build another house. I mean, it's a strategy. So it's just like anything, right? Whatever people are comfortable with doing, it creates an option for them. So
Yeah, I mean, from a planning perspective, if you think about it, you may be more inclined to focus on paying down the note, right, a lot quicker, right? Especially if it's a little bit of a higher interest rate note. There is more incentive to reducing that debt liability on the property to eliminate any debt on it and allow their property to continue to appreciate at a tax-free value over time. So planning-wise, there may be more of a focus to say, hey, instead of utilizing this capital for other investment purposes, let me pay down the debt on my primary resident, get it down to nothing, and now that whole appreciation process is done tax-free. So, I mean, that would definitely be something that would be in consideration.
And I think the calculation of the net return, I think it's all over the place. You have people that will say, I purchased a house for $200,000. It went up to $500. I made $300. The way my mind works is, do I add the property taxes? Do I add the interest rate? What about when I made maintenance, the lawn, the lights? Is that part of investing into property? And everyone's calculation is so different, so it's hard to compare apples to apples.
yeah, I think it's real important what he just mentioned about people doing upgrades or doing remodeling, things like that. It's very important for them to keep track of all that information because that can also add to their cost basis, right? So going back to that example where someone had a $300,000 gain and they might not feel like they can exclude it all, well, they might have had $50,000 in remodeling and repairs over the years, which could increase their cost basis, pushing them closer to a 250 gain instead of the 300, therefore not having to pay any taxes.
Yeah, you know what? That's a great segue as we wrap. Okay, so well, I hear you right. That's one tip. Keep track of your cost basis. What are some other tips that people could take advantage of to make sure that they get the full benefits of 121?
Making sure that they understand the use test, right? That 2-year mark, right? The worst thing in the world to happen would be to sell the house at 1 year, 11 months, and 28 days or something like that, right? So make sure they understand that. So 2 years is a very important number, right? So that way they can understand if they have time to qualify.
Watch our podcast.
That's very insightful.
Quick.
Subscribe, please.
And on that note, please make sure to follow, like, and subscribe. Thank you. Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.